What's going on, everybody? It's Jeff here. Welcome back to the channel. Happy Friday. We still have about an hour left till market close. What I want to talk about in this video was this chart that was shared all over Twitter yesterday in various different formats. This shows the Federal Reserve's balance sheet. And as you can see, there's been a massive spike. Okay, went up about $300 billion from around that 8.3 trillion all the way up to 8.6 trillion, about a $300 billion bump. And there goes everybody saying, listen, quantitative tightening is over. We are back to quantitative easing. Now, if you're unfamiliar with quantitative easing is, that's very easy monetary policies, low rates, stimulus, a lot of benefits, and mainly, like I said at the beginning, low rates. And what that does for the market is the market really likes that. All of your companies that are valued off of future revenues, they are constantly, like these high tech companies that are constantly borrowing, okay, to create new technology and innovate. Those are your stocks that will run, right? You look at your Microvision, ran from $1 all the way up to 30. That was in a time of quantitative easing. So this was shared all over the internet, and I want to talk about this, especially because this is yesterday's chart. We came in, we opened up just around that 387 area, bounced up a little bit, formed a double bottom, and then moved all the way up to 396. We've since sold off a little bit. Currently, right now, we're sitting at 389. We might sell off into close. Okay, but we've kind of been magnet around that between 390 and 392 area so far as of today. But let's talk about specifically what this means. And let's go into a little bit more detail about this. Okay, so this was another thing that was all over what JP Morgan had said, that the Fed could add up to $2 trillion to the economy with its new bank lending program. Now, when you initially read this headline, you think of quantitative easing, maybe another form of stimulus. They're pumping $2 trillion to the economy. And it's very important to understand the fine print of this, okay? So the maximum amount projected by JP Morgan is 2 trillion. However, another number mentioned was 460 billion. That seems to be a little bit more accurate. Let me break that down just one step further for you guys. So the Federal Reserve, in conjunction with the government, had created this new funding program, meaning if banks are going to run into liquidity troubles, they can go to the Federal Reserve to borrow money. Okay, it's going to be borrowed. This is not going to be given as of right now, okay? But this is going to be borrowed. Now, in order to borrow this money, there has to be collateral, okay? So that means instead of selling off bonds, okay, like Silicon Valley did for selling off, a huge $21 billion bond portfolio, taking a $1.8 billion loss, instead of that happening again, if you're in, liquidity issues, you can borrow from the Federal Reserve. There needs to be collateral. What is going to be used as collateral? Any type of treasury or mortgage-backed security currently held by the bank, okay? So let me break that down even one step further, okay? And why it is showing up as a liability on the Federal Reserve's balance sheet. So think of it like this. You own a home. You have equity inside your home. You go to the bank and you apply for a home equity line of credit, okay? Now, upon approval of that line of credit, if let's say that line of credit is for $100,000, even if you are not using any amount of that $100,000, that is currently a liability because you have access to that. Meaning, okay, potentially in the future, let's say you're trying to buy a car or trying to buy something else, and they run a credit report, they will show that you have the ability to access this money. You applied for it, and therefore it needs to be listed as a liability, in the Federal Reserve's case, listed on their balance sheet, okay? Now, in order to even get approved or use any part of that home equity line of credit, you have to have equity inside your home, okay? Meaning they're basing that value of that line of credit off of what you currently own for value, equity inside of your home. It's very similar to what is happening right here in a very broad, easy to understand term. Okay, these banks running into trouble, they can go to the Federal Reserve. The Federal Reserve is trying to prevent another Silicon Valley event happening. Okay, by no means is this back to quantitative easing. Okay, or in my opinion, even quite yet away from quantitative tightening, which is the raising rates and so forth, we'll get into in just a moment. Quantitative easing takes us back to the pandemic, right? Us as, just civilians, and some people, other people, they got stimulus checks, okay? Then you look at people who own businesses, they got PPP loans. Now, I want to say 100%, but very close to 100% of those PPP loans were never had to be repaid. Okay. That is a straight injection into the economy. That is quantitative easing. Rates were pretty much nothing, if not nothing. Okay. And, monetary policy was easy. It was easy to borrow money. It was cheap to borrow money. Okay. I refinanced a couple of the properties I had, even though I had some equity in them. I only had, 20 and 25 years left on a couple properties. I rolled them out, to 30-year mortgages. Okay, they are investment properties. I rolled them out to 30-year mortgages because it was just so cheap to borrow that even though I'm paying more over time, I can still take that extra capital, be able to invest it myself or buy a new property. And it just made complete sense. So that's the type of activity that happens. We are nowhere near that as of right now. So while some of the, Twitter and, headline, media headlines had talked about this, it's important to kind of understand it, right? And obviously the market did react very strongly off of it. I'll zoom out again, just a little bit further for you guys just to see. Right now, we are still kind of back in this channel. All right, but here we go. We popped right out of it, reacted very strong, selling off as of today down to, like I said, about that 390. We've been magnets at 390, 392 pretty much today. We'll see if we get a little rally or a dump into close, but it's important to know this. Now, let's get into a couple other things. I want to talk about in 5 days, the FOMC meeting is coming up. They're going to have, their rate decision. Now, the current target rate is about 475. 36% of investors, what is priced into the market right now, is saying that they are not going to raise interest rates at all, which would bring us to my second phase of the Fed pivot, which would be known as the pause. We will talk about that in a further video. I want to talk about the upside potential and the downside potential. Now, anytime rates have come in at hints of pause, rates have come in, under expectations or par with expectations, the stock market has rallied, okay? Phase two might be completely different. And the reason being for that is because it shows that there is strain on the economy, strain on the financial markets, which we've already seen. Like I said, we'll talk about that in another video. 64% of the market right now is pricing in a quarter basis point hike. Okay, inflation still is still out of control. Okay, even though some of these numbers are coming in a little bit lower than expected, a little bit higher than expected, PPI came in a little bit lower and so forth, it's still out of control and it is very far off from that 2% target. Okay, now if the Federal Reserve and Jerome Powell come out and say, listen, we're not going to shoot for 2% target, we're going to shoot to get it down to a 3 and 4%, and that's just going to be a way of life. Well, I will tell you, everyday Americans, they are going to struggle, and it is only going to get harder as these months continue to go on and commodities just continue to cost even more. So, like I said, there is some downside with that, but you have to go with at least what Jerome Powell is saying as of now until he is proven otherwise. And like I said, we are very far away from getting to that target rate. There is a lag effect, which is why I think the market will start to price that in a little bit closer. So looking at the market from a little bit broader of a perspective, we are still very much in a chop zone, okay? When you take a look at this, even though we hit that low of about that 348 to 350, we have that, let's say that range high. I would call that range high of about, 417, going back to at least, let's say around that May area. We've really just moved absolutely nowhere, okay, in somewhere around 10 months. All right, we've been range bound. We're also getting tighter. These swings are getting lower and lower. There's a lot of volume coming in here, both selling and buying pressure as we've seen over the last couple of days. So just keep that in mind. I think there's going to be a big, pause and a lot of just hesitation, lower volume going into the FOMC. And it'll be very interesting to see what words are said by Jerome Powell, especially after we have had a couple different reports. It's been a little while since the FOMC has met, and we've seen some financial struggles. Now, I will mention to you this, okay, over across the ocean in Europe, all the issues with Credit Suisse and the ECB, they still raised 50 basis points. They went strong on it. So it's really kind of torn up. But most importantly, I hope that this video explained to you in a very brief, easy to understand manner, okay, of what that chart exactly shows and how it's quite different from quantitative easing. So guys, that's it for this video. See you in the next one.